All right, TikTok's live. Go live. I don't know why it won't let me click. Oh, there it goes. Go live on Instagram. And then share. Get the chats up. All right, I think we're live.
I see you on YouTube.
Nice. What's going on, everybody? I think I'm going to close out of this call here.
Yeah.
All right, everybody. Welcome to the Crypto Den. I thought I'd come to you all today to talk about an issue that is, long-standing. I mean, we have been dealing with probably some of the most uncertain times in the market we've had in, I'd say, 4 years, right? COVID. COVID was the last time we saw equities, the S&P 500, go down more than 10% in a week. And when COVID happened, right, the Federal Reserve decided to do some QE, or quantitative easing, and it allowed the markets to roar back up. And the main question is that going to happen again? Is this bull run over, or are we going to shoot to the moon? And is Powell going to come in and save the day and give us some quantitative easement, is what QE means? And if so, how is that going to affect the markets? And that is my job, amongst others. But my hedge fund, Bleeding Edge Capital, I manage my clients and my investors' capital in these markets, and I'm poised to attack this question in a lot of different ways. And there's a lot of data that I use to help me get a sense of what's going to happen in the next few quarters. The reason why I talk about the Fed and Powell and it's boring is quantitative easing, right, is what allows money to exchange hands more freely. You could think of it that way. And quantitative tightening kind of tightens that money. That's why it's called QT, or quantitative tightening. It means that money is more expensive. A way to think about that is via interest rates, okay? Interest rates determine the cost of capital. It determines how expensive debt is, right? If debt is more expensive, people need more of a return, right? If you were going to go borrow $10 million to build a new factory and you're a company, and it was going to cost you 6% or 12%, $60,000 to $120,000 a year to build that, it's going to change, that's just an interest alone. That's not the principal as well. It's going to change basically what you're going to do. And quantitative tightening makes debt more expensive, and quantitative easing makes debt cheaper. Cut rates, do all this stuff. If you cut rates too low, inflation goes too high, right? Look at the Biden era, of course, CPI, 7, 8, 9, 10%. And that's from the quantitative easing that was a response to the COVID crash. And then we've been doing quantitative tightening. And Bitcoin is still, as rates have went up, Bitcoin has still been chugging along, which is super interesting. which is why this market crash could cause the Fed to pour on the quantitative easing and take everything up with it. That could be a possibility as a response to all of this. Or I have an alternative that I'm wrestling with, okay? That's just here locally, right, in the country. We have this ebb and flow of money coming in and out, the cost of it from the Fed, and we have Trump at the helm, who is trying to basically wrangle other countries and provide fair trade. Fair trade basically would mean all of the countries that currently have tariffs against us would drop their tariffs. Now, this is an interesting part. Pretty much every analyst and everyone looking at it, including myself, was under the impression that in general tariffs would be inflationary. And they are. They certainly are. Trump increasing tariffs globally across the board to over 100 countries absolutely is an inflationary move. The country's response, though, if the presence, right, of tariffs is inflationary, then the lack of tariffs would be deflationary, right? Deflation is bad for Bitcoin. It is bad for gold. It is bad for luxury items. It is bad for home prices. It is bad for hard assets. And essentially, a lot of these countries are saying we will not tariff America at all anymore. That means we can now sell F-150s in Germany because there was 200-something% tariff on automobiles. They wanted all their citizens driving German vehicles, and every country has made those kinds of decisions, all the way up to India doing a 700% tariff on some imports. So we could potentially open up the attainable market of our largest, most profitable companies, which is great for equities and pretty much bad for everything else, because if there's less dollars needed to complete a trade, that is de facto deflationary. When tariffs are used, that means more dollars are needed to complete a trade, and that is inflationary, essentially. And with less dollars circulating the world and being used to settle trade because there's less tariffs, you could expect that the dollar will get stronger, right? Inflation is weak against the dollar. The dollar will get further. You can take a dollar further, especially with the way the dollar has been treated. And I'm wrestling with these two outcomes as a manager. I'm wrestling with this idea that we could be entering a deflationary period, and there could be quantitative easing coming up. I don't know if he will, but there could be. So, is this over? I don't know. I want to take you to some charts, and I want to show you some indicators that I personally use. I don't make all of my decisions off these indicators, but in general, they help me have an idea of which way the wind's blowing, right? Are we in general going up or down? And you do that by monitoring the order book, right? So if you think about price is just this variable. It's a number that changes based on the number of buys and sells. You could think of a ping pong paddle. I'm bouncing a ball up and down, up and down, up and down. Those candles, that's the ball bouncing up and down, up and down. Every minute, every day, every week, every month. That's depends on the time frame you're at, but the price is just a result of the order book. And I like to watch the momentum of the order book to know how many sells versus buys there are and in what time periods. And that should give you an idea of which direction the price is most likely to go. And in this indicator right here, this is the Bitcoin USD chart. We're on the monthly, okay? Now these are larger time frames. On the monthly, we have, well, actually on all of these charts, the 3-week, the week, the 3-day, the day, and the 12-hour, and you can do whatever you want. There's a lot of different ranges here. But I like to look at the largest time frames, and then go down. Okay. I want to show you guys the correlation here. Whenever the blue line is on top, price is going up, 17 to 30, while this blue line's on top. You can kind of see the pattern. Blue line on top here, worst red month ever, 8,000. Blue line goes on top here, it goes on top here, and then the blue line goes under. Look at that. We go from 8,000 to, what is that, 55,000, and then we go all the way down to 29,000 with this cross down. And you can see the RS, this thing right here, and it's a similar correlation. This is the most lagging indicator right here. Now this is called RSI, stochastic RSI, and the MACD. RSI is called the relative strength index, okay? It is just telling you, this 50 line right here, it's just telling you 50 means it's an even order book. If the line's above the 50, it is more buys than sells in the month. If it's below the 50, it's more sells than buys. And the direction of this thing tells you in general which way the order book is going. So right now it's pretty flat, meaning there's an even amount of buys and sells in this month so far. And then the stochastic RSI looks at the RSI, this same thing, but it has two different time ranges, 14 months and 3 months. The blue line is 3 months, the 14 months is the orange line, okay? And then this is 12 and 26 months up here, 12 months, 26 months. That's why it's so lagging. The lines have larger data sets in this top one. So in the past, what this is telling me, okay, now you guys understand it. What this is telling me is that there are more sells in the past 3 months than buys in the past 14 months. So that tells me right around here, we started seeing massive sell-offs, and it's driving the order book to the ground. If this orange line and blue line both cross below the 20, let's zoom out. Look at price. Look at this. Go to 69 all the way down to 15. What about the last time? We go from 17 all the way down to 3. Okay? And nothing turns until we have the blue line flip up top. We have more buys in the previous 3 months than the last 14-month sells. It's pretty simple. And you can see here, being below the 50 level on the RSI is the bear market. Very clearly bear market, right? What this means is I'm looking at the Bitcoin chart. Everything correlates to Bitcoin. XRP, XLM, Ethereum, at least for the moment, every altcoin, alt token, every alternative project, literally anything other than Bitcoin, however you want to say it, is correlated to Bitcoin. Bitcoin is the largest market cap of all the tokens. So if everything follows Bitcoin, you really only need to worry about Bitcoin. And for the first time in what is this? December of 22. See how the blue line ticked up here? Since December of 22, we are now looking at a major bear market fall off. This is called bearish divergence. When price is at all-time highs and the order book is stacked against it, that's bearish divergence. That tells me in the next 3 months we're going to realize these sells unless the buys turn this thing around. Unless something happens, and it could. Unless something happens, Bitcoin will crater. Bitcoin's going to crater. I don't know how far but it's going to crater. And then if I go to Fred, if you guys follow my channel, you know I love Fred. Absolutely love it. M1. I just realized that I am not. Hold on. There we go. Okay. So if we look at Fred here, and we go to M1, Fred is the Federal Reserve Bank of St. Louis. It's basically just it's the Federal Reserve's data. So this is exactly the amount of money that we printed that the Fed printed. The Fed and the government are two different things, okay? They're completely different things. And what this is showing us is we had, for all my people out here that think I'm a full-blown Trumper, okay? Oh man, I can't, hold on. Let me move my display here for you. So from 1976 all the way to 2020 right here. This is Trump, by the way. Trump did this in his last term. Look at these dates. We printed for COVID. This is the quantitative easing I was talking about. We printed 3.8 to 4. We're at 4 trillion, all the way up to 16 trillion. The Fed literally 4x'd our money supply. And all of the S&P, SPY 500, all of this performance, yeah, why are you not? Actually, here, I'll just go to Trading View here. So, look at this. Do you think this and this, look at the dates here. Do you think that's a coincidence? I mean, y'all, we went from 2,500 to 6,000. And look at the M1, okay? Now, let's go look at M2. M2 is the money that gets, I say, washed by the banks, but these are all of the productive loans. Look at this thing. Right out of COVID. 8,000 all the way up to 22 trillion. So we have 8 trillion, I said 8,000, that's my fault. 8 trillion to 22 trillion. Now, 16 trillion on the M1 chart means there's trillions unspoken for, one. So not all the money went, right, to productivity. Trillions of it went to social programs, and that's what Doge is finding. The difference between the M1 and M2 is the fraud, okay, mainly. I do not think that we are going to see quantitative easing quick enough. I just don't. I don't think that we're going to see it. And if we don't see QE, because remember, look what happened, right? We go all the way down here. Powell cuts rates, shit goes crazy. He starts cutting rates. Look at that, market goes down. We go from 0 to, or not 0, it was like 1 or something, all the way up to 5 in like that. Because he was like, yo, this is getting crazy. Quantitative tightening comes in, messes up everything, right? He starts cutting again, things go up. So what I'm saying is this large fall off right here is worse than COVID. That's objectively true. And and Trump wants him to cut rates to start quantitative easing to recover. It's actually twofold. I think he doesn't really care about the stock market. He really wants rates to be lower because the federal government is going to be refinancing debt, and he wants the debt to be cheaper to reduce our deficit, okay? The problem with him wanting to reduce our deficit means that he is going to be running in a surplus. If the federal government runs in a surplus, okay, that is deflationary, period. We have a 20-something percent. Actually, let's go figure that out. Check this out. Okay, check this out. We have a U.S. Gov debt to income ratio chart. Take this out. Oh, this is not. I don't want to see the states. That's not what we're looking at. Come on, I know you got it. I know you got it. Come on. Where? You can see I've clicked around to see this stuff before. And here we go, Fred. Fred never disappoints. Look at that. Fred never disappoints. Okay. So this is the debt to income ratio. I'm going to make my box a little bit smaller so you guys can see it. Okay. So this thing right here, this is our debt to income ratio. If you've ever bought a home, you know that's pretty important for getting a mortgage. Take a look at this. We were responsible. Everyone's talking about the budget, government spending, all this other stuff. This is what we're talking about. The gray bars in the background are the recessions, you know, negative GDP growth, right? Or I guess decay. GDP decay is what the black bars are, okay? That's COVID, right? Very brief. But we have went from a few percent over, you know, 102, 103, that's your inflation right there, all the way up to 132, and it's trending down. That means we're running cheaper than we were, okay? 120%. He wants to fix 20% of our debt. He wants to get down all the way back to right here, healthy levels. That's his goal. That means for the next 3 years, 3.5 years, we have a president that is only concerned about fixing the deficit. If we fix the deficit, that is net deflationary in general. Deflation is bad for hard assets like Bitcoin. The fact that this is going down, and we go to the DXY, look at this. This is the strength of the dollar relative to other currencies. Look at this. Guys, this is deflation. Look at this. You think it's a coincidence? Do you guys see how all the charts go up from that M1? Do you guys see that? Like, it's crazy. Take a look at this. I'm going to keep talking about it. We print in, let's say, May of 20. let's take it to June or July for the charts to really do their thing. Get out of here. M1 search results. Okay. Federal debt. Q2, Q3. Boom. June. We go up from 104 to 132. Right? Looks the same. SPY. June. June of 2020. Where are we at? That's March. June of 2020. 3,000 to 6,000. Okay. Debt to income. Right? DXY. Hold on. Get out of here. They love to sell their shit. It's crazy. March. That's June of 20. Here we go. June of 20. This is the DXY. Right? Look what happens. Cuts rates. Quantitative easing. We go all the way up to 115. Massive inflation. And we've been trending down. Just like our debt to income ratio. These are correlated. The more debt to income, the more inflation. The less debt to income, the less inflation, meaning deflation. For the first time ever, not first time ever, I'm being dramatic, but since 2022, we have a fair dollar. And he wants to weaken the dollar. He's talked about that. That's literally called deflation. So I guess all of this is suffice to say, I am trying to rationalize this chart right here. And when I look at the economy, I look at the Federal Reserve, all I'm seeing is confirmation of deflation. I'm not saying the bull market is topped, it's over, like it already topped. I'm saying that the most likely scenario is Powell's going to hold off on QE too long. Trump's going to drive in deflation, at least right now. And for a period of time, I think it's most likely we realize these sells in the order book and Bitcoin is going to go down. And it very well could be the biggest opportunity of our lifetimes. No different than the last bull market or bear market. When I started this channel, I started investing, I started my fund. It is, volatility is a gift for those that are prepared. And I personally think in the short to midterm, we're going to get capitulation. We're going to get some turbulence in hard assets, in commodities and things like that. Not only will deflation fix our budget, it'll also reduce home prices. It'll reduce the cost of living, the cost of oil. That's, I got to show you this, okay? It's the last, keep forgetting. Look at that. Inflation, deflation, with a sharp fall off from Trump's presidency. Okay? You heard it here first. Make sure you sub, make sure you like, you follow, and let me know what you guys think about these lives. I'd love to know. I do think the bull market is on its way out. I do. I personally in my fund I'm around 70% deployed, so I'm still in the market, but I am putting more and more profit and cash to the side, waiting for this turn. I don't know if it'll be 3 months from now, 6 months from now, whatever. I'm happy with my blend at the moment, but I'm definitely taking some chips off the table and sitting fat and happy until this shit hits the fan and we get a better opportunity with lower prices. Thank you all for tuning in to the Crypto Den. I appreciate you guys. And until